Welcome back to the Dividend Diplomats YouTube channel. You've got your boy Bert and Lanny representing the DED here on the Zoom. And guys, we're here to talk about two massive dividend growth stocks. Are they undervalued? Is this a good time to buy them? Let's find out.
Before we jump in though, everybody, you know the drill by now. Smash that subscribe button. Just give us that thumbs up here. Help us keep growing our YouTube channel, but more importantly, spreading the word of dividend growth investing so we can all help grow our passive income, your passive income, everyone. Come on, everyone. Let's work together to get to financial freedom.
Guys, this was another volatile week in the S&P 500 ending February 25th. Because what goes down comes right back up. And in fact, the stock market, the S&P 500, aka the top 500 stocks out there, actually finished the week barely up, literally up 0.08. It was pretty, you could call it flat for the week, but at one point, and it finished at 43.85 rounded, but at one point it was down over 200 points. I believe on Thursday morning. On Thursday morning, the market throughout the week was down 200 points, and it came roaring back up. Obviously, Bert, you know a few of the big reasons why the market's so volatile right now.
Yeah, I mean, the major story is obviously what's going on with Russia and Ukraine. So I'm sure the stock market, like everything else, is going to be twisting on a dime, hearing about the news of what's going on. Hopefully we can get to a quick resolution here so it's not too bad, because it's things more important sometimes in the stock market, just working through some of these items, but we're all going to be along for the ride from an investing standpoint. But even outside of there, it's not as if this was a very quiet time in the market anyway. We were constantly dealing with the ups and downs from inflation, from interest rate hikes. We were watching every jobs report, every earnings release like a hawk to see if we can get a better idea of what's about to happen in 2022. So yeah, it's been an interesting week in the market, an interesting month, and it's only going to be crazier going forward for the next few weeks.
And you'll catch on our later video this week all the dividend stocks that we were buying while the market was this volatile. Obviously, as Bert said, what's going on right now is much bigger than the diplomats, much bigger than YouTube in general. Obviously, there's a very, very tough time right now for the world. But that doesn't mean that you need to stay on the sidelines when some dividend stocks go on sale, right, Bert?
Right. And that's why it's always important to keep your eye on stocks, no matter what's going on, to see what stocks are undervalued stocks to buy. And that's why we're going to be looking at two companies here. So what we're going to be doing, we're going to take these two competitors in their sectors, the titans of their industry, nonetheless. We'll take a quick look at some of their financials, look at their income statement, balance sheet, see what's been going on there. And then we're going to run them head to head in our stock screener to see if one or two of the companies are considered undervalued stocks to buy, or if there's one that is just significantly better than the other one based on the metrics today.
Yeah, and these are two stocks that sometimes there are always tough times to try to find the right time to buy the stock, just because of the price to earnings ratio, potentially overvaluation. They either have had a run up in stock price, or maybe dividend growth has slowed that has kept you on the sidelines. And with the downturn in the market this year and this past week, it's a great time to look at the transportation / shipping industry. We're talking about Big Brown, and I don't know what you would call the other one, but we're talking about UPS and FedEx, two of the shipping giants, the logistical beasts in the industry.
Yeah, you can look out your front window, you can look down the street. Chances are throughout the day, you're going to see multiple trucks from them driving by, a lot of packages getting thrown around here. And that's what was kind of funny. They're the two companies that, if you want to talk about winners of the pandemic from an industry standpoint, from a future revenue standpoint, they benefited mightily from it. Because think about it, people from going to stores, they changed how they're shopping. So many people now are just ordering online, having things shipped from home, getting things delivered. They can return stuff back. Free shipping labels are sent. You take it to UPS, you take it to FedEx. It's all good stuff. So yeah, these companies should be on your mind. Oh, there you go, Lanny. Nice little FedEx shipping box right there.
Got them all over this place.
Yes, yes, we do. But yeah, that's why it's going to be interesting to see, because it's an excellent point, Lanny. Are we catching these two companies at a downtime? That's the important thing. And that's what we're hoping to find out with this video.
And we're going to look at the stock screener metrics from the Dividend Diplomats. Diplomats focused on three metrics. One, the price to earnings less than the S&P 500 and less than the competition. Here are the two competitors. The dividend payout ratio, preferably less than 60%, and the sweet spot's 40 to 60. Then we'll look at the dividend growth. You're a dividend investor because you want to build a passive income stream that not only pays you now, but that income stream goes and grows and beats inflation every year without you having to do anything. Last but not least, as Bert likes to call it, the cherry on the top, the colossus of clout, the LeBron right hand, slam when it's, about to finish the game, or the Triple H pedigree. We're talking about the dividend yield.
Yeah. So should we jump right into the screener here? Or do you want to look through some financials first? What are you thinking, Lanny?
You know what? I think we talk at a high level real quick.
Yeah.
At the financials, Bert, you could take up the first company. We could dive, spend about 30 seconds to a minute on each company here.
Let's do it. All right. So just quick income statement. FedEx in their last earnings release here, 6 months, they have the off-cycle fiscal year end and quarter end. So their 6 months ended as of November 30th. Want to catch all that Black Friday activity in there. So it's not surprising that that's the month end for them. Revenue was up 14% though. Conversely, net income was down also by 13%. So revenue up 14%, income down 13%. Obviously facing things like increased fuel costs, increased operating costs, et cetera. You know the drill there. One thing to take a look at, though, balance sheet from nice perspective. We always look at the current ratio, or we always look to see current ratio to show, can your current assets cover your current liabilities? Can you cover those bills with the short-term assets that you have? We look for 1x. FedEx blows out of the water with a 3x current ratio. What are you seeing here with UPS?
Wow, that's pretty amazing. So that current ratio means FedEx is fairly liquid, fairly nimble, and can react very quickly to changing macro and microeconomic factors, such as increasing costs. So we'll be able to really see what they do in the second half of their fiscal year. So UPS, ticker symbol, and Bert, you love this, UPS.
I do.
They have a 12-month schedule on the calendar year. So they posted year-end results, and wow, was it nice. Revenue was up about 15% year over year. And the net income, after you adjust both periods really for the pension related charges and also inversely, fluff income, net income was still up about 30% year over year. So that really has propelled UPS to do some pretty amazing things. And if you haven't caught it in one of our recent videos, that dividend yield was juiced way up this year. The dividend increase that they announced after these year-end results was a 49% increase.
Yeah,
Literally.
that was a mic drop. Everyone just fall out of your seat. That was freaking awesome. I mean, you knew they were kind of making up for their previous year's lackluster dividend increase, but you would never have expected a 49% dividend increase. That was unbelievable.
Unbelievable. They don't have quite as great of a current ratio as FedEx does, but there's still 1.4x, so still above that 1.25 that we like on the current ratio standpoint.
You know what? If we didn't talk about FedEx's current ratio being 3x before we talked about UPS's, we would say 1.4 is a phenomenal current ratio on a standalone. So both can be great. You don't always have to have, it doesn't have to be competition. Both can just be awesome.
Yeah, I completely agree. So Bert, I think it's time we're going to take a look at the dividend stock screener metrics here for UPS and FedEx. We'll kick it off with UPS. Again, on the close of business on February 25th, ticker symbol UPS for the UPS Brown Delivery Truck Service. They were trading at $209.95. Analysts are expecting going forward $13.50 in earnings from UPS. So that you take that share price over that expected earnings, PE ratio is still fairly low at 15.55 times forward earnings for UPS. How about for FedEx?
All right, their share price $220.72. EPS was $22.89. Their PE ratio is only 9.64%. So they are trading at a significant discount to UPS. So,
Huh.
yeah,
Interesting.
yeah. But hey, I mean, net income's down, revenue's up. Revenue's up for UPS, and net income was up 30%. So one company's hitting both, the other one, great revenue, worse income. You can see why one might be trading at a discount compared to the other.
Which is actually interesting because on a 52-week basis, UPS is up about 33% since last year. FedEx is actually down 13%. So it makes sense why FedEx has a lower price to earnings ratio.
Yeah, let's move into that payout ratio there. So again, we always look for a payout ratio under 60%. We're always keeping an eye because in the long run, we don't want it to creep towards 100% because you can't pay out more than you earn. That's not sustainable for anybody, any company. Doesn't matter what sector. We look for 60% or less, but we also think that perfect payout ratio is between 40 to 60%. So Lanny, why don't you tell us, after UPS jacked up that dividend by 49%, where is their payout ratio falling?
So surprisingly, even after a 49% dividend increase, because they pay $1.52 per share per quarter, or $6.08 per year. Gosh, it just sounds nice, that much of a dividend. But their payout ratio is still perfect. Perfect, baby. Guys, UPS's payout ratio is 45%.
Phenomenal. All right, let's see how it compares to FedEx. Annual dividend $3. Divide that by the 22.89 EPS. That's a big disparity right there. I can already tell you that payout ratio is nothing. That payout ratio is 13%.
Whoa. Let's, guys, yeah. Bert, what does that tell you about what FedEx can do?
Well, I guess there are two ways you can look at this. Was one, there's plenty of room to increase the dividend. That's obviously the optimistic one. I think that's where you're going with it, Lanny. There's going to be plenty of room for FedEx to keep growing that dividend. The other one that I was going to joke around and say is just how much are they expecting that net income or EPS to fall during the year too? Because that's where it could go in the other direction.
Could go in the other direction.
Obviously, I guess there are two ways to get yourselves up to a perfect payout ratio, and we'd obviously love the first one. But all jokes aside, very low payout ratio. Not concerned about the safety. Take what I said about the earnings decreasing there. There's plenty of room for earnings to continue to fall and for FedEx to continue juicing up that dividend. That's the important thing of why it's great that they have such a low payout ratio.
We'll have to pay attention in the summer where FedEx will occasionally, and I say occasionally, increases their dividends. So really pay attention to that May or June time period this year to see what they do. So, hey, low payout ratio. Love it. Yep. Time to dive in to the third metric, dividend growth. So UPS is on 12 plus years of growing that dividend, of propelling the dividend on a go forward basis. Even with that increase, they're at a 6.41% on a 5-year average because they had some pretty bad dog years of increasing that dividend.
Yeah, that's what the 49% was, definitely a makeup probably for some of the years past, but
yeah, because we all know last year was about 1%.
Average of 25% though over the last 2 years. Take it. All right,
can't lie about that.
Yeah, let's compare to FedEx here. 5-year dividend growth rate of 15.53%, although their consecutive annual dividend streak is only 1. I'm gonna go on a limb though. In the summertime, they are going to double the number of years they've increased that dividend to 2, because there's plenty of room to keep growing that dividend.
All right, Bert, I would love to see that for FedEx and for the FedEx stockholders. That'd be pretty cool to see it. Like you said, plenty of room. So let's get into that bonus metric, that dividend yield. What is really going to be paying you today? Obviously dividend growth could obviously propel the yield on cost forward, but you want to know, how much does this pay you right now? And is it better than a high yield savings account or the S&P 500? So UPS's dividend yield right now is 2.90%. So well over 2 times the S&P 500. And that is after that 49% dividend increase for UPS stock.
So FedEx is in line with the S&P 500 with a 1.36% yield. So, it doesn't surprise though. Take a step back. UPS's payout ratio is double. So you would expect a yield that's more than double of where FedEx is. Not a surprising number right there.
The ratio is like triple.
Okay, triple. So whatever. You know the point. I'm kidding. Okay, so triple, but the trend is still the same. Much higher payout ratio. You should expect to see a higher dividend yield from there.
So I guess here's the question, as we run through the summary of the metrics, UPS has a 15.5 PE ratio, 45% payout ratio, a 6.5+% dividend growth rate, 12 plus years of growing the dividend with a yield of almost 3%. Bert, how does FedEx look?
Yeah, 9.64 PE ratio, 13% payout ratio, 15% 5-year dividend growth rate, increasing that dividend for 1 year with a 1.36% yield.
Let me ask you this, Bert. Do you think, is this a good entry point or a good time to buy FedEx stock? Because you never really see it this low of an earnings multiple. Plus, the yield has actually come back up from where it typically could be, being down almost 14% in the last 52 weeks. What do you think about FedEx stock?
No, I think that's a very accurate thing. That's what I was thinking after we're going through this analysis here. I mean, the PE ratio is significantly lower than UPS. You saw UPS take the trend of a 1% dividend increase in the prior year, then catch up to 49% dividend increase in there. Is there room for a similar trend like that from FedEx during the year? You could argue that there is, with strong revenue growth. Even though there's a slight decrease in earnings, there's plenty of room to continue growing that dividend, though, because that payout ratio is so low.
As a UPS, I know you own UPS stock. I own UPS stock. We both probably own quite a good amount of it. Check out the link in the portfolio in the description below the video. Because of that, obviously, I probably won't be buying FedEx stock. One could argue both dividend stocks here are great ones to buy. Probably FedEx is more of I would say a higher growth stock typically. UPS is more of your clang and bang dividend growth community stock.
Yeah. So let us know, everybody, what you think about UPS versus FedEx, what your thoughts are on the result here. Be interested to see what you think about FedEx right now. I think, yeah, the metrics are very interesting. So who knows? It can't hurt to have them on your watch list, though. You never hurt to have too many good dividend growth stocks on.
Guys, we appreciate you always for stopping by, especially as we put on some, Zoom YouTube videos for the Dividend Diplomats channel. If you haven't already, definitely give the video a nice thumbs up, because we are trying to still reach the millions and millions of dividend investors out there. That was Bert, and this is Lanny from the Dividend Diplomats. Over and out.